This is the video lecture on partnerships. Whenever we talk about a partnership, we're talking about a business that has been organized as a partnership. And if you'll think back to an earlier video, we defined a partnership as a business with more than one owner. Now, every time a partnership is formed, there's always a contract that's referred to as a partnership agreement. This is a very important contract because there's going to be all sorts of information included in this contract about how the partnership is to be formed, who the partners are, and once this is signed, it forms a legally binding contract between all of these partners. And of all the details that are included in this partnership agreement, as an accountant, the one part of it that I am most interested in is what type of agreement they have about profits and losses. Because remember, in a partnership, the profits and the losses are going to be shared among the partners. So they have to come up with some type of an agreement as to how they're going to do that. And based upon that agreement, it will actually affect how I record the transactions for a partnership. Now, when they originally organized the partnership, we're going to be admitting partners. And every time a partner comes into the business, we're going to have a certain amount of contribution from that partner. And what that person contributes could be many different things. It could be cash, it could be any type of asset, buildings, land. So we would accept all those assets as part of their original contribution. But at the same time, if we're going to accept someone as a partner, not only do we take responsibility for their assets, but also for the liabilities that they might also bring with them. So you always have to watch out for that. Another unique aspect of a partnership has to do with the capital account and the withdrawal account. Now, up until this point, we've seen both capital and withdrawal accounts, and we've seen how they've been used in various problems. But up until this point, every business that we've ever dealt with has actually been a proprietorship. Now, how do I know that? Well, think about it. Every chart of accounts of every business that we've looked at up until this point has had only one capital account and only one withdrawal account, and it had the name of the owner. Well, now that we're beginning to deal with partnerships, we're going to have multiple accounts. How many of those accounts depends on the number of partners. So for every partner that we have in our business, they all have to have a separate capital account and they all have to have a separate withdrawal account. And we have one of those set up for each individual partner. Now, this first example is a fairly basic example of the organizing of a partnership. We have two individuals, Smith and Jones, and they're going to start and organize a partnership. Now, Smith's investment is $100,000 cash. Jones' investment is a building worth $50,000, equipment worth $10,000, but also Jones has taken out a $20,000 business loan. So in order to start the business and get everything kick-started, we need a couple of journal entries. We're going to do a journal entry for each partner to establish a capital account for that partner. Now, this is the first entry. This is for Smith, and the Smith entry is going to be the easiest because literally the only thing that Smith is investing in the business is the $100,000 cash. So I'm going to debit cash for $100,000 because now that money belongs to both of us. Now the money belongs to the partnership, and I will establish a capital account for Smith by crediting Smith Capital $100,000. The Jones entry is a little bit more complex. Jones was actually investing two different assets. So that $50,000 building and the $10,000 in equipment both of those assets need to be debited because they are now business assets. But at the same time, Jones had taken out that $20,000 business loan. So remember, when we take someone on as a partner, we not only become responsible for their assets, but also the liabilities. So that's why we have to credit note payable $20,000. And then we establish Jones capital $40,000. And the reason it's 40 is that even though Jones is investing $60,000 worth of assets, it's balanced out somewhat by the $20,000 in liabilities. So really the value of Jones capital should only be $40,000. Now once we establish the partnership with those two entries, hopefully after they operate for a certain amount of time, hopefully they'll be successful. It's possible that they may have a net income. Then again, it's possible that they might have lost money. But either way, that has to be divided among the partners. Now remember, we talked about the partnership agreement. That partnership agreement is going to specify how these partners have decided to split the money. So according to the terms of the agreement, they've decided on a 60-40 split. 60% to Smith, 40% to Jones. And once they agree on that and sign that agreement, that is a legally binding contract. That's the way we will always, until we get further notice, we will always divide profit in that way. So according to this, they did make a profit. First year of operation, a $500,000 net income. So in order to share that among the partners, we will close out the income summary by debiting that for $500,000, and then we will increase the value of both capital accounts. 60% of that, or $300,000, goes to Smith. 40% of that, or $200,000, goes to Jones. So it increases the value of their capital. Now something else that will sometimes occur is sometimes we will have new partners who would like to join the partnership, especially if we have one that is successful. Most businesses don't even turn a profit in their first year, and this one has. So we'll probably start to attract new partners. Now if a new partner is going to join, that's up to us. It's up to us as the original partners to accept that person. And if we do that, not only do we have to establish the capital account for that partner, but we will also have to amend the partnership agreement to come up with a new way of splitting the profits and losses. So in this example, we have a new partner that's being admitted, and this partner is Carter, and Carter wishes to join the partnership by investing $30,000 cash. So we will allow Carter to do that. We will accept their cash by debiting cash, and that it now becomes the business's cash. And then we will establish a capital account for Carter to the tune of $30,000. Now, in addition to accepting a new partner, it's also possible to have the dismissal of a partner. And sometimes people will decide to leave the partnership voluntarily. Then again, other times people decide to leave because they're having a conflict. And sometimes we might even want a partner to leave. We might even encourage them to leave, especially if we're not getting along and if we're having difficulties. Now, anytime a partner leaves, we actually have to remove that person's capital account. So if you look at this example of the dismissal of a partner, say that Smith has decided to leave the partnership. Well, when they leave, what we need to know is immediately prior to their departure, we need to know what their capital balance is. And in this case, the capital balance for Smith happens to be $100,000. So what we will do is simply remove that capital account with a debit, and then we will credit cash to show the payout when we give Smith the money. So that is the example of when a person leaves the partnership.